Yeah, good evening, everybody, and welcome to the Unicus and Surya webinar on RBI's final ECL directions on asset classification, provisioning, and income recognition for banks. Today, we have a team from Unicus and Surya FinTech, and what we propose to cover over the next 60-odd minutes is some of the salient features of these particular directions in the context of starting off with what has changed since the initial draft regulations which were issued leading up to the final directions. Thereafter, we'll spend some time on the modeling aspects of the expected credit loss and the implementation issues one may potentially encounter around that particular area. Thereafter, we will move on to the accounting and related implications, followed by the technology-related aspects one may consider as they move towards implementing ECL from 1 April 2027. Finally, we will cover the governance and other related aspects and also the implementation challenges associated with that particular topic. And towards the end, we have kept approximately 15 to 20 minutes for Q&A as well. Also, as a part of the process, during the first 60 minutes, if you have any questions, do feel free to put down those questions in the chat box, which is available, in the Q&A box, which is available towards the bottom end of your screen. To clarify, use the Q&A box and not the chat box. And in the last 15-20 minutes, if you do wish to ask a question in person, do raise your hand. And my colleague Jimmy, who's also on the call, will unmute your line and we can have an in-person discussion as well. Also with me today are Suresh and Shyam, my colleague partners from Unicus, who lead the financial risk management practice. I also have Bharadwaj, who's from Surya FinTech. Surya deals with a number of tech-related aspects for banking companies, and Bharadwaj leads the product around the ECL from a technology perspective. And my name is Sagar Lakhani. I'm a partner in the accounting advisory practice at Unicus. So with that, let's kick off on the core content itself. So Sarah, if you could move to the next slide, please. So starting off with the first section of what are the foundational elements of the directions. And I think it would be safe to say that this is based on 4 key pillars, which is staging, floors, the transition requirements, and the governance around this entire process. Starting off with the staging, unlike the erstwhile IRAC norms, where the focus was predominantly on DPD-related outcomes and the related provisioning, to some extent, whilst the ECL framework does also dwell upon that as a foundational principle, however, in substance, there are a lot of qualitative elements also which are becoming equally critical in the quantification of the provisions, whether an exposure is residing in the performing or the non-performing category. So the way the directions are structured, 3 key stages: stage 1, stage 2, stage 3. Stage 1 requires a 12-month ECL provision. Stage 2 and 3 require a lifetime ECL provision. The framework or the directions have codified certain DPD criteria for assessing whether exposure is stage 1 or stage 2. Similarly, the DPD criteria also translate into quantifying or determining what is an NPA asset. And some of these elements, like the 60-day, the threshold which has been included for working capital facilities, is also very India-specific outcome compared to what we see in IFRS 9. And finally, the directions introduces a very unique concept of SICR, which has not been seen in the IRAC framework earlier. And the determination of SICR does translate into a assessment of whether an exposure will have a stage 1, which is a 12-month ECL provision, or a lifetime ECL provision. In terms of quantification further, the framework does define certain floors as well, which are determined or codified by product, whereby the expectation is that the banking companies will maintain at least that quantum of provision in the context of the products which they have as a part of their banking operations. These floors do vary product by product, and very interestingly, and which we will discuss a little bit later in the discussion as well, especially when one talks about doing a borrower-wise assessment in the case of NPAs, there are certain floors which are also defined for FVTPL type of exposures. At some level, this is very counterintuitive because why will FETPL have a provision itself from an ECL perspective? But there are certain nuances in the direction which we will talk about in due course. From a transition perspective, 1 April 27 is the go live date. So approximately 10 to 11 months from today. The directions are clear that the initial day one impact will be recorded through reserves rather than through P&L. And from a capital perspective, a 4-year glide path has been provided for capital calculations. Moving ahead of 1 April 27, there are 3 quarters where there is an expectation of dual reporting both under the IRAC regulations as well as the proposed ECL directions which go live from that particular date. March 28 will be the first year when it will be the solo ECL numbers which get reported, with an option to the companies whether or not they also want to present comparatives on a ECL basis or otherwise. From a governance perspective, again, very, very heavy governance focused in the context of implementation as far as the directions go. There's an expectation that there is going to be a board CFO CRO subcommittee which is constituted, which monitors the implementation of the particular set of directions, as well as in terms of taking ownership for a number of application and judgmental matters which come along with the implementation in place. There is also an expectation of a 3-tiered model risk framework which is established by the institutions in question. The 3 tiers are pretty much the first, second, and third line of defenses, which one would generally see in a very robust risk management framework. And RBI does recognize that certain institutions may seek external help in terms of quantification of the ECL outcomes. For this, they have indicated in the directions that if that were to be the case, then the RBI as a supervisor should have access to the vendor models as well. And those models should equally have gone through a robust review within the banking institution as well. So while that's set the foundation for the how the directions are structured, I think it's fair to spend a couple of minutes also on how do these directions differ from the global ECL rules which are embedded and codified in IFRS 9. So whilst there are a number of nuances, but if one were to thematically call those out, 4 key areas again. One is the concept of floors does not exist under the IFRS 9 framework. However, the RBI directions are quite heavy and quite granular in terms of establishing floors across the product class, and these floors vary from product to products. Second is on the income recognition for stage 3 assets, where IFRS 9 does require recognition of interest even on stage 3 assets. However, the RBI directions require the accounting for stage 3 income only on a cash basis. So in effect, the directions are more conservative, and they're also in line with the current IRAC norms where the NPA income is recognized on a cash basis. The third element is around the stage 3 conclusions, where from an IFRS 9 perspective, if there are multiple exposures to a borrower, then the need to impair a particular facility or exposure is governed purely by the behavior of that particular facility. i.e., a adverse performance on one facility does not necessarily require the other facility also to be classified as a non-performing asset. However, the RBI directions do mandate a borrower level NPA conclusion. And once exposure slips into, or one facility to a particular borrower slips into a stage 3, then it is expected that all exposures to that borrower will also be correspondingly impaired. So what does this mean in comparability as well, apart from the above differences? Also, all financial institutions or banking companies have to be governed by IFRS 9 as far as global institutions are concerned. In the Indian context, small finance banks, payment banks, and local area banks have been excluded from the purview of the circular. So whilst a majority of the banking system will be covered by the particular requirements of these directions, however, still there is a part of the lending segment which may not necessarily be applying the ECL provisions on 1 April 27. Sarah, next slide, please. So what we also try to cover is also provide a little bit of a journey and the historical context of what was included in the draft circular and what finally transpired. But before that, I think it's also fair to say that, look, the journey towards ECL in India started in pretty much in October 2015, when the RBI working group issued its advisory report in the context of applying Ind AS for the banking sector. And thereafter, multiple debates, conversations, deliberations happened between the RBI, the industry, and the government, culminating into the RBI through its monetary policy statement in October 25, indicating that they were ready to go ahead with ECL, and thereafter issuing their draft guidelines again a week later by the 7th or 8th of October 2025. The draft guidelines or directions did include a number of matters on which there was a representation from the industry to or for the RBI to evaluate in terms of assessments before they issue the final directions. The RBI did agree to some of the representations of the industry. And conversely, there was another part of the feedback and suggestions which were not supported or agreed to by the RBI. So again, some of the main areas where the RBI held firm and did not dilute its position was around the start date. And in the way they rationalized it, that the 4-year capital play, as well as the deferment of the EIR by another 3 years, where they have given certain concessions, should be good enough in the context of then pushing the industry to go live with ECL from 1 April 27. The second ask of the industry, which did not go through, was that the expectation was to provide more granular implementation framework. However, to a great extent, apart from the introduction of the floors, the RBI has left the implementation judgmental based. And that, again, is going to be dependent on the portfolio types of the banks in question, as well as the historical performance and behaviors of some of these portfolios. Similarly, on the floors, for stage 1 and stage 2, the industry had certain feedback to lighten that particular conclusions. However, the RBI has maintained those floors which were initially suggested. And similarly, on the 30 DPD SICR threshold, the industry ask was to have a softer threshold there. However, the RBI did not adhere to or agree to that. And also from a collateral perspective, the industry had requested for a period longer than a 2-year time period. RBI has retained that 2-year time period. However, from a threshold perspective, they have been a little bit more accommodative, where they've increased the threshold from 5 crores to 7.5 crores. Equally, though, there were certain areas where the concessions have been granted. So, for example, on EIR on the legacy book, the RBI has permitted the use of contractual rates until March 2030, and has not necessarily pushed that all banks should be ready with that by 1 April 27, which is the transition date. Similarly, on revolving facilities for SICR, unlike the 30 DPD, which has been applied for the rest of the portfolios, revolving facilities have a 60-day threshold there, which is a little bit of a relaxation compared to the other portfolios, as well as different from what one sees in IFRS 9, which also indicates a 30-day threshold. They have agreed to provide a DLG benefit in the calculation of ECL computations. Similarly, on floating provisions, the circular does quite categorically indicate that the existing countercyclical and other provisions may be used by the bank when they are quantifying their ECL provisions as a part of the overall first-time implementation. And in terms of the cooling period of moving from stage 2 to stage 1, they have agreed with the dispensation around that. So now the regulation, the way it stands, is that as long as the customer has performed satisfactorily and is cleared on his past dues, the ability to upgrade is a possibility without having a cooling period there. So that was just a quick summary of the move from the draft to the actual directions, as well as the foundational principles of the directions. We straightway now move into ECL modeling and discuss some of the implementation matters, which one could potentially see in this particular journey, for which I will hand over to my colleague partner, Sham. Sham, over to you.
Yeah. Thanks, Sagar. As Sagar mentioned about some of the key fundamental aspects of ECL, however, I quickly talk about some of the key 5 concepts about ECL modeling and the computation perspective. So first, banks are now required to move beyond 12-month risk estimate and develop their lifetime PD term structure, incorporating forward-looking macroeconomic conditioning. This means that risk estimate must not only reflect what the current behavior of the customer is, but it also covers that what credit risk is evolving over the portfolio at an individual borrower level as well as the portfolio level over the life of the loan, and that too under different macroeconomic scenarios. The second aspect, RBI has introduced prudential floor as a mandatory backstop, both at a product level as well as a stage level, to ensure that ECL outcomes remain very much conservative and that do not fall below the regulatory expectation. Now, the very third aspect of ECL and very fundamental aspect is related to the SICR assessment, which is now a very continuous process. Earlier, banks used to depend highly on the DPD bucketing only, but now with the revised guideline, what it tells the bank is to consider not only just a qualitative and the quantitative factor, but also looking some of the forward-looking aspect in order to assess the current stage and the current category of the loans. LGD on Sagar has also highlighted about the DLG. So some of the collateral as well as eligible default loss guarantee that has to take into the consideration for estimating your LGD estimate, that will make your recovery assumptions more risk sensitive, and that will be aligned to actual recovery, whatever is possible from those particular bucket. And then finally, I'll talk about on the PD and LGD floor. And these PD and LGD floor are something which makes your output not too optimistic in terms of its implementation. Though there are many more concepts, but I thought these are the relevant ones in the context of how any bank will take into the consideration, and when it comes to the actual implementation, what are the challenges. Shara, can we move to the next slide? And I would like to talk about some of the challenges what these different aspects will bring in. And Sagar has also highlighted that these guidelines are quite prescriptive, but at the same time, there is a lot of judgment which has been provided and bank has to take a call. Now, the first 2 point, if you talk about, or if you see, is the JLG and the SICR staging. So SICR, why it is relevant? Because if you see, SICR is something which avoids the cliff effect. Fundamentally, why SICR has been brought into the picture, because earlier what used to happen, a standard loan used to take 0.4% or a very small amount of loan provisioning, but at the time of NPA, it will suddenly jump to 25%. So in order to reduce that increase in provisioning or smoothing that provisioning, SICR has been brought into the picture. Now, I'll take some of the example that how SICR become a practical challenge in the real life. Now, take an example of JLG. In the JLG, which is a joint liability group portfolio, let's say one borrower in that particular group is performing very good. There is no sign of delinquency. There is no sign of any problem, stress. But let's say similar group has couple of borrower where you'll say they are slipping. Now, there is some issue in the repayment and there is some early sign of group contagion. Now, ask yourself, does that current borrower stay in stage 1, or group stress will put account into stage 2? And that's exactly what the kind of call bank has to make while doing the SICR assessment. Now, the trade-off is very clear. Now, if you move all the accounts of that particular group into stage 2, you are over provisioning. But while if you don't take that particular stress into your assessment, what will happen? The account will suddenly move into NPA, and probably all the accounts will become NPA, and you are exposed to a sudden increase in the provision. Here is a very interesting example about the second aspect, which is now non-fund based exposure. Now, think of a letter of guarantee, or let's say letter of credit. In case of guarantee, what is there? It is first of all non-fund based exposure. And now let's complicate this example. Let's say you don't have any funded exposure against this borrower. So what will happen? You have nothing to monitor as a regular book. You don't see any utilization, and there is no visibility about how this account is performing. Now, what will happen? Until unless the guarantee is devolving, you'll consider this in a stage 1. And what will happen? At the time of devolvement, there will be 2 effects. One, all the contingent fund will become your funded exposure. So exposure will suddenly increase. Secondly, what will happen? Account will move directly from stage 1 to stage 3. And that's the fundamental problem, that if you don't consider SICR, you are not taking account of cliff and you are exposed to a significant increase. With this, I'll just move on to a very simple example, which is the third point about 2 upgrade road and 2 different direction. This point is related to MSME portfolio. So what generally happens in the restructured cases? For restructuring cases, RBI has explicitly tells that you need to look at the performance before you upgrade the account from stage 3 to stage 1. Now, if it is not MSME, what will happen? The account will first move from stage 3 to stage 1, and with the significant performance, it will move to stage 1. So in general cases, it will move from stage 3 to stage 1, stage 2, and then stage 1. What RBI has come up with a simple solution. Let's say if this is MSME exposure, you can simply move from stage 3 to stage 1 directly. Now, in this case, what is the thing? Policy intent is very clear. Rules are very clear. But where comes the complexity? The complexity will come whether the bank is identifying the MSME eligibility criteria, number 1. Second, whether the threshold of exposure is monitored very carefully, because in case of a stress, the exposure moves very frequently. Now, these 2 criteria, if you are able to match or monitor, then you can take the benefit of that restructuring rule. Now I'll move to the 4th aspect of the slide, which is right to cancel unconditional cancelable commitment. Now, in case of undrawn commitment, what we usually see, bank generally have this misconception that if they have right to cancel, just because putting a clause in the contract, that doesn't mean that you can take the benefit of 0 CCF in the case, because RBI view is very, very different. They are saying demonstrate it. Just 1 clause in the loan agreement is not enough. You need to evidence that bank were able to cancel and execute the right in the past. So unless you do some of the behavior modeling and demonstrate it, the benefit is not at all real. Now, what is the fallback you can adopt? Bank has prescribed that you can go with the capital circular, which is 5% for the initial 3 year, and after that you can go ahead with 10 year. But now if you take some of the example, let's say cash credit or overdraft, which are just 1 year loans. RBI has also prescribed that in your utilization behavior bucketing, you need to not only consider or model CCF only for 12-month view but also you need to consider the view of lifetime. So probably it's not just about modeling CCF, but uniformly you need to consider, because what happened, bank may have experienced this also. At the time of stress, the utilization level of these kind of facilities, let's say the revolver facility, cash credit facility, overdraft facility, suddenly increase. So if you take the benefit that in the new normal course of action, the utilization is certain percentage, definitely in the stress, the utilization is not going to be the same. And these are the practical challenges. While you may have very sophisticated model, but there are some judgment call that you need to bring in to bring more practical challenges into the picture. The last 2 aspects I'll talk about 5-year macro assumptions and TTC PIT conversion together. So let's say RBI is very, very explicit, and in one of the disclosure template, they ask you to provide 5-year macro assumptions. Now, frankly speaking, you must have seen that you can forecast, let's say for 12 months or 24 months, the GDP forecast, inflation or something. But how fair it is to estimate a macroeconomic forecast for 5 years? The answer is possibly no. And if you look at Indian banking scenario or the historic performance, this is a very difficult problem, because even though RBI has prescribed some mean reversal techniques or something, but the speed of those mean reversal, the speed of recovery is not very uniform. So this brings a lot of challenge in how you do the modeling. Now the modeling becomes more complicated when it becomes the lifetime PD, because again, till now, based on our experience, we have seen that people use survival analysis. So what they do, They come up with a PIT-PD model, and then they do survival analysis to forecast or extrapolate PIT-PD to TTC-PDs. The current guideline says, or I would say prohibits to use this. It's not allowed now. You need to forecast PD term structure based on the real experience or the risk associated with that. So in summary, I'll just say that while the guidelines are enough prescriptive, but a lot of judgment is there. And while you read more about these guidelines, you'll see the nuances attached to these individual portfolio. Some of the banks may expose to these, may not expose to certain kind of risk associated with the slide, but you'll see the more you go on the practical approach, you'll find the real problem. Over to you, Sagar, for the next section.
Thanks. And just a reminder for the participants, if there are any questions at any point in time, do use the Q&A box to put in your questions, and we will try and respond that in parallel. So moving on to the accounting section, from a guidelines perspective, 5 key accounting implications. One is the need for fair valuing the entire loan portfolio on 1 April 27, which is the transition date. The second one is, and which can be very, very data intensive, is the entire piece around the application of EIR on the portfolio, which then translates into the appropriate or the relevant income recognition. The third expectation is that each of the transitional adjustments will be recorded in retained earnings. The circular is quite clear about that. The fourth element from an accounting and reporting perspective is the fact that for the first 3 quarters, there will be a need to undertake parallel IRAC as well as ECL reporting. And there are some very comprehensive disclosures as stated in Annexure 4 of the directions. So for keeping these 5 thematic points of the reporting expectations arising from the directions, let's now go through some of the potential implementation matters which the teams should be aware of. So the first one is around the day 1 fair value quantification. So the circular is again supportive in the sense that one could use the carrying value as a proxy for fair value, as long as one can demonstrate that the delta is not material or the carrying value is going to be representative of fair value. However, one area where there could be potential challenges is the existing NPA book of each of the banks under the IRAC norms. And let me spend a minute on this. So if you think about it today, the IRAC provisions are governed by predominantly by the DPD-based, tenor-based provision percentages which are getting used. And they may not necessarily be representative of the fair value of the portfolio. So especially for the current NPA book, one could potentially see material fair value deltas between your net carrying value and the fair value so determined on 1 April 27. And also for certain other portfolios where the loans have been given at discounted rates. So for example, certain loans where the government prescribes lending at a below market rate, or certain employee loans where the rate of interest may be off market. Each of those outcomes will have potential fair value adjustments coming through. Now, the question which subsequently arises is that whilst this fair value delta will be a 1 April 27 transition adjustment recorded through reserves, but is there a need to further split that fair value amount into fair value determined by credit-related changes or fair value determined through other interest rate or FX-related changes? So again, the circular just indicates that, look, you record this fair value as adjustment without giving the second level of guidance of whether a split or not is required. So one could very well take a position that everything is a fair value chain. However, when one goes to the disclosures, particularly table 3A in Annexure 4, that table also requires the opening to closing reconciliation of the ECL provisions. So especially for the existing NPA book, if indeed there is a large fair value difference on those books and everything is made relevant, or everything is applied to a fair value change with no delta being applied to a credit change, effectively, from a provisioning perspective, when one thinks about ECL, the provision coverage ratio could be significantly underrepresented in a way. So this is a call which, again, the banks will have to take as to how they want to play this. A potential approach is also to get a clarification from the RBI in terms of what is the RBI is thinking about it. But as I said earlier, if one just reads the pure text of the circular, one could lead to an outcome that it's all a fair value change without anything being attributable to credit, hence warranting a further split. So that is point number one. Point number two is the EIR switchover. So whilst the EIR requirement is quite clear, two options are there. Either apply EIR on the entire portfolio on 1 April 27 for the catch-up adjustment recorded in opening reserves. The second option is continue for the existing stock of book on 1 April 27, continue with the contractual rate till 130 and make a switch at that point in time. And of course, for new loans which get originated from 1 April 27, the expectation is that those will anyways be on an EIR basis. But for the opening portfolio, if a bank were to take a position to take the exemption and continue with the contractual rate and switch over to EIR only from 1 April 30 and do the catch-up at that point in time, the question is whether that catch-up adjustment should be a reserve adjustment or a P&L adjustment. Now, again, if one thinks or one reads the directions, in two instances where the RBI wanted the impact to be taken through the reserves, they have called it out very clearly, saying that the impact should be taken through reserves and not through the P&L. However, these wordings have not been used in the para where the option for the transition in 2030 is available. There, the directions use the words more generically to say that the banks may account for it appropriately in the financial statements. Now, again, if one were to look at the detailing in terms of the other paras where it's clearly called out, take a reserve adjustment, don't take it to P&L, and the absence of use of these words in such a specific manner in the para of 2030 transition, again, one can conclude that it's a potential P&L adjustment in 2030, and a reserve adjustment may not be possible. But again, something to dwell on as you firm up your accounting views for your respective organizations over the next few months. The third element is the treatment of countercyclical and floating provisions. So here, as I said earlier, the RBI does permit the use of these buffers and provisions as a part of the transition adjustments. But having spoken to a few banks in the industry, certain banks have asked the question saying that, look, if you want to continue with these provisions and not use them, do we have that option? Now, the reality is, because the ECL model is forward-looking, the resultant outcome of the model is what the ECL provision will be. The directions also permit certain post-model adjustments, subject to the governance around those model adjustments in the context of the board, CFO, CRO subcommittees, and the 3 lines of defense, etc. However, the question is whether the existing counter-cyclical or floating provisions can be articulated as a post-model adjustment. Personally, we think at this point in time that it may not be possible. And then the question is, but if you still want to continue and retain some of those provisions, can one engage with the RBI and make a play saying that, look, why don't we treat this as regulatory provisions, for example, and then keep them outside the purview of the ECL model? And as far as the usage of these provisions is concerned, will be guided by the advice or the approvals of the RBI in future whenever a usage may be required. So again, those optionalities may be possible. One will have to, again, carefully think through, and this will vary from bank to bank, also basis their day one impact, the quantum of the existing counter-cyclical and floating provision buffers, etc. But the point I wanted to leave with this group at this stage is a floating and a counter-cyclical, the way it is currently defined, may not necessarily meet the framework of ECL the way it's defined in the regulations. And still, if there is an intent for that institute or organization to want to continue with those provisions and not use them, one may then have to think about a more nuanced approach as to how one does get to that particular outcome. Point number 4 is around the fair value through P&L and the non-performing investments interplay. So this is an interesting one in the sense that fundamentally, if something is a stage 3 or an NPA asset, one switches over to a borrower-wise provisioning as well as a classification, as we discussed. Now, also when one looks at para 17.2 of the directions, that's a scope paragraph where the paragraph highlights all the financial assets which are a part of the coverage of the directions. However, 17.2 very clearly excludes fair value through P&L debt. Okay. And the logic is simple, because if a position is going to be on a fair value basis, then anyways the downside is captured through the P&L. And then also the FVTPL does not meet the SPPI criteria, which is a key requirement in the context of going down the ECL quantification route. However, one of the subsequent paragraphs also then seems to very clearly indicate, saying that if you have a loan to a particular counterparty and you have exposure to the debt of that same counterparty, if the loan has become a stage 3, then that FVTPL debt also has to be provided as per the floors which are provided for products in the particular circular. So an interesting one, and then the rationalization we think why that is the case is there's always a time gap between fair valuing some of these debt positions vis-a-vis some of the financial stress which may have happened between the date of the last fair valuation and the reporting date. And maybe the RBI's intent here is that, look, even if it's the FVTPL debt, if a loan is impaired, basic floor provision will still be required in addition to the fair value downside. What will become important is how does one monitor it? Because as a mindset, clearly everything which is FVTPL gets excluded from the overall assessment. But again, we wanted to highlight that there are certain exceptions even to that, this being one of them. So again, as you go ahead and implement these provisions into your tech systems as well, some of these points will need to be called out or carved out in an appropriate manner, even in your tech systems, so that they are flagged and it can be accounted for appropriately. Point number 5. When will these be stage 3 assets, i.e. NPA assets? And our assessment and view is that it will be, because it will meet the definition of the credit stress in that paragraph where 6 or 7 conditions are defined, and effectively you could see a large part of your standard asset portfolio which is currently classified as such. And again, the stock of that portfolio will depend from bank to bank, but potentially that will be a NPA and a stage 3 under the ECL directions. Point number 6 is around the write-off policy. Now, and the question is, will the write-off policy undergo a change by virtue of moving to the directions? And again, this is going to be an interesting and a judgmental area for the following reasons. If you take a step back and think about the current write-off policy, based on the bank's best assessment of recoverability, and at times banks also write off basis what is optimal from a tax optimization perspective. Now, if you think about it from a ECL perspective, the way the circular is worded is that one gets to 100% provision based on the bank's best estimate of the recovery assessment. So in a way, one is taking a position in the LGD assumptions, saying that I'm not going to recover anything, hence my loss is 100%, so my recovery is 0. Now the question is, for ECL modeling, one has taken a view that there is nothing which is recoverable vis-a-vis the explicit words of recovery assessment of the bank in question. Then, is it right to show that asset as a recoverable on the balance sheet? Okay, and then that's going to be the point in debate. Now, the slight distinction between the IRAC and the current ECL direction is IRAC was DPD based, which took you to 100% provision. Now, through the directions, one is taking a positive, or one is making a positive assertion that I, as management, am concluding that I'm not going to recover anything from a particular asset. Hence, my loss given default is going to be 100%. In that particular situation, is a recoverable still defendable on the balance sheet? Now, one could still argue saying that, look, I don't believe this is the right time for a write-off, even though I believe I'm not going to recover anything. But one will have to determine a view as to why one is making that statement. And that in some form and manner will also need to be codified in the governance structures which are prescribed in the circular. The seventh one is a 3 quarters dual reporting, where one needs to put out both the IRAC and the ECL numbers. And this is where it gets interesting, is the IRAC numbers will be subject to auditor review or audit, assuming an institution is listed. There is currently no guidance of what or how one deals with the ECL numbers, i.e. will they need to be audited, will they need to be reviewed? Clearly, no real guidance available at this point in time. I'm presuming at some point the SEBI will also come out with its own guidance on this particular aspect. And then one will have to watch this space for more in terms of what does this mean practically in terms of certain ECL numbers which will be out in public domain. And then will they need an additional level of review from the statutory auditors of the bank in question? And the final piece is around the comparatives. So I think para 145 to 50 deal with putting out the numbers from March 28 for the first time as far as the annual period is concerned. The footnote 11 does give some options to the company to say that, look, if you want to provide comparatives, you have the ability to do so. However, where it gets again very interesting is if one goes back to disclosure 3A or table 3A in annexure 4 of the disclosures, the same opening to closing reconciliation, which I alluded to, of stage 1, 2, 3 of loans, as well as the related ECL provisions, that roll forward is also required for the period of 21 April 26 to 31st March 27. Now, if the intent of the circular is applicability from 1 April 27, the question arises as to how is an entity going to provide a roll forward from 1 April 26 to 27? We think 3 options are possible. Genuinely early adopt the standard, which provision is available, so you can provide that. Second is populate the previous year with the IRAC numbers and give a footnote disclosures with one separate line item of transition adjustments to then get from IRAC to ECL on 1 April 27. Or the third option is just state 1 April 26 to March 27 is not applicable and focus only from 27 to 28 in terms of the roll forward. Again, each bank and each institution will have to take their own decision. And a lot of the matters on this slide, I think there could be some potential RBI discussions and conversations as well to get to the ultimate outcome. But again, some of the accounting matters which we thought we'll put it out in terms of the assessment. And in due course, I'm sure the respective teams will get to the right answers for their own institutions. So that was on accounting and reporting. Now we'll quickly move to technology. Bhardwaj, over to you.
Yeah, thanks, Sagar. So from a technology point of view, let me first focus what exactly guidelines are expecting, right? And then I'll move into the practical implementation challenges which most of the institutions would be facing, right? Typically, when you see the robust solution framework is not only about ECL modeling, but it also starts from the loan origination itself, right? Where institutions must capture the right characteristics of the borrower. Now, let's say once the loan is originated, then comes the NPA classification, which again has to be completely automated, system driven, and should not have any manual interventions. During this entire life cycle of this loan contract, credit risk framework becomes equally critical, where all the qualitative risk indicators, the watch lists, and the forward-looking overlays can be basically integrated into the staging and provisioning platforms, right? Now, on top of this is where the overall modeling layer sits, where the calculations of PD, LGD, the CCF modeling, EAR computations, as well as lifetime and 12-month cash flow calculations, and having scenario or stress testing capabilities, all of which require clean historical data sets and strong computational engines, right? Now, once the output is generated, it doesn't end there. Finally, there is a lot of guidance note on the model validation and governance aspect as well, where basically each and every model assumption override, finally the provision output must be independently be explainable as well as auditable from a regulatory standpoint. Now, what ties all of these together are the core guiding principles that have been well articulated as well, which talks more about what should be the validation controls, how the role-based access controls should be there, how the data straight to processing kind of a capabilities between the upstream, downstream applications should be, and various other aspects when it comes to the audit trail as well as the audit-ready environments from a regulatory point of view. So the key takeaway here is that the guidelines are not only about just a provisioning engine, rather they necessitate banks to build a regulator and management ready operating platform. Right? With that context, let me move to a couple of real implementation challenges which are faced while building this overall ecosystem, right? While the guidelines again define what exactly banks need to achieve, the real question is how practical is it to operationalize all of this within the existing framework, right? So this is where the ECL implementation is not purely a modeling exercise, rather it's a bank-wide technology transformation challenges that is faced. So picking it up from the previous topic which I was mentioning, the first challenge starts at the loan origination itself. Most of the LOS or CBS platforms were built for booking and servicing the loans, but not capturing the granular data attributes that would be required from a ECL staging point of view, or the prudential floor mapping, or the behavior analysis framework that will be required. Even something as common as a, let's say, product restructuring during the life of the loan is systematically not tracked in the solution, which results in incorrect provisioning as well. The second challenge is around the NPA classification. On paper, the NPA classification looks very straightforward, right? But operationally, many institutions still do not have a fully automated, let's say, a borrower level and a facility level NPA engine, which runs consistently all the contracts or all the borrowers at the day end across the various source systems or the LMS platforms that are there. And also the income derecognition or interest reversals and the reconciliation processes are still partially manual in many institutions, which creates basically friction between the data sets which are getting reported across the finance, risk, and the regulatory reporting databases as well, right? Now, the third layer, when we talk about the credit risk orchestration, this is where it becomes a bit more complex because ECL requires bank to convert qualitative credit judgment into a kind of a system logic, right? This is where the risk users or the relationship managers may identify, let's say, a borrower or counterparty level management stress, the covenant breaches, or the sector deterioration. But these signals usually sit in presentation decks, emails, or watch lists, but not inside the provisioning engine in real-time basis, right? So the biggest question comes, how do we operationalize this overall qualitative risk into measurable and auditable staging triggers as well, right? Assuming that, let's say, we have the entire data set, then comes the modeling challenge, which is where most of the implementation timelines tend to go sideways because calculating PD, LGD, the CCF, as well as the year calculations, these all depend upon long duration contract level historical data sets that are not in structured form, right? The recovery timelines may exist only in legal files. The fees and commission data may not have been stored at the contract level historically. And also during the course of the product or during the course of the bank from the inception, the product definitions and the risk grades change over time. So this breaks the overall concept of cohort building from a modeling point of view. And if it's a newly launched product portfolio or the portfolios where basically the defaults are low, right? There isn't enough statistical depth to cleanly distinguish between the overall stage 1 and stage 2 behaviors as well. And similarly, the governance and the model validation part of it, which will be covered in detail as part of the next slides as well. And one of the critical or of late, let's say an emerging issue that we see is because of the overall co-lending ecosystems, right? The overall portfolios are also increasing across institutions. Now, co-lending requires multiple institutions to basically exchange the borrower status, how the repayment statistics are, and also the staging signals in real-time basis. But practically speaking, this real-time risk synchronization of data simply does not exist across the institutions, right? So that creates inconsistency in the classification and the provisioning alignment, and also how the borrower level visibility is there across the participating lenders, right? Now, this is where perhaps the overall implementation approach itself becomes critically important, because under ECL, regulators and auditors as well as board will eventually ask a fundamental question: where exactly did this provision number come from, right? And answering this requires far more than a calculation engine or a policy document. Rather, institutions need to have an end-to-end traceability, the ability to automatically track each and every unit back to the originating data, the assumptions applied, the overlays considered, and also the overall governance actions that have been taken throughout the life cycle of the contract. Right? Secondly, it's not purely a global templatized exercise which can be brought into it, because Sagar has also highlighted what exactly is the deviance between a typical IFRS 9 and how the RBI guidelines are. So the regulatory expectations also evolve differently across jurisdictions, right? So the implementation success also depends on how quickly institutions can operationalize the overall RBI specific nuances, the disclosure expectations, as well as the staging interpretations, right? And while doing this, while standardization is important from an overall system maintenance point of view, risk itself is ultimately institution specific. Each bank has its own borrower mix, portfolio behavior, different restructuring patterns, and the recovery experience as well, right? So, which means that the implementation framework must be adaptable enough to reflect overall institutions' credit culture, but not just a regular or a generic solution framework that is applied. So going forward, the differentiator may not be simply how the provision is calculated, but how the overall experience based on the regulatory understanding, the implementation agility, as well as the institutional support can be leveraged for a sustainable operating framework as well. Right? So that's basically from a technology perspective. I'll leave the floor for the governance aspect of it.
Yeah, and before that, actually, Bharadwaj, I would just add one point, and Sarah, if we can go back on the previous slide, especially this last point, I would just like to spend like 30 seconds on this co-lending models. See, in the recent past, a number of banks and NBFCs have jointly gotten into this co-lending structures. And very interestingly, the directions indicate or mandate that if the exposure of the borrower to the co-lender as well is impaired, then even the banking company needs to classify that as a stage 3 on a real-time basis or not later than the following day. Now, if one thinks about the SMA reporting and to the CRILC, including for default reporting, there the entire reporting cycle, the earliest is a weekly reporting cycle for defaulted accounts. So operationally, this entire matter around assessing whether the borrower has defaulted with the co-lending partner and factoring those data points into your own reporting requirements will need some technology intervention in a very focused manner. Because unfortunately, in terms of the timelines of compliance, the directions don't leave any room beyond the next day. So just I thought I'll emphasize that point, because currently I don't believe there is a real-time sharing of data in most of the instances between the banking companies and their NBFC lending partners. Suresh, over to you.
Yeah, sure. Sarah, next slide, please. So we have covered till now the directions, modeling aspects, accounting implications and the whole technology architecture. What we'll focus on the next 10 minutes, probably one of the important aspects of the entire ECL framework, right, on the governing uncertainty. Now, if we look back and see on our existing framework, the incurred loss framework, if we talk about the governance was largely governance around the rules, right, which are already there in the framework. Now, under the ECL, the governance becomes more of judgment governance, right? Because under the ECLs, banks are no longer provisioning only for what has happened in the past, but they are also provisioning for what they believe is going to happen, and hence the governance, importance of the governance, right? And after going through the whole directions, the philosophy at which RBI has written certain things about the governance and many of the paragraphs, right, it is very, very clear. So there are five aspects which we'll talk about first. One, the board owns the ECL. Now, what do we mean by this is RBI is basically elevating the ECL from a technical exercise to a balance sheet governance issue. Yeah. Now, the board is not expected to understand every model parameter, but it is expected to own the prudential consequences which will be arising out of these models. Yeah. The second is, I think, which Sagar is also alluded to in the start, which is on the three-tier model risk framework. Now, RBI is effectively importing the institutional model risk governance discipline into the provisioning, and the ECL models will be then treated as far as with the same seriousness with the other models which are right now in the banks which are there. The third aspect is on the board approved policies across the areas. Now, what RBI basically is looking for is the institutional consistency in judgment wherever it is being applied in various components of the ECL, right? Now, without formalized policies, staging logic may differ across the portfolios, overlays may become arbitrary, or there may be macro assumptions which may be taken based on the opportunity, right? So opportunistic based assumptions. So for policy formalization becomes a governance anchor, which is one of the requirement. The fourth on the third party accountability. Now, RBI is making it very clear that outsourcing models does not outsource the accountability. While wherever the banks are using the external vendors or the third party engines for the models or for the technology architecture, the explainability responsibility continues to remain with the management, and that's the core expectation. If we look at the last one, which is on the whole disclosure of the transitional arrangement, right, which will start soon, 2/27, April 27. RBI understands that transition discretion may materially distort how the comparison is currently happening. Therefore, transparency itself becomes a prudential control going forward when the transitional arrangements or the reports are being published by the respective banks. Sarah, next slide, please. Now, while covering some of the requirements around the governance, few of the implementation challenges which we believe gonna be the core of this. One is on the whole audit defensibility. Now, in the ECL world, every material judgment must leave an evidence trail, right? The questions eventually which will be asked by the supervisors or the inspectors, right, during the inspection would be, let's say, why was a particular macro overlay has been applied? Why was a stage 2 threshold calibrated this way? Or how the management has has override certain things. If a judgment cannot be evidence, eventually it will be challenged, and that's gonna be one of the key areas when the implementation of the ECL models are gonna happen. The second is on the overlay governance. Now, historically, overlays were quite exceptional in the rare cases, but under the ECL now, overlays may become structurally recurring. And why? Because the macro uncertainty itself is recurring, considering what is happening in the last 4-5 months, and these kind of events will keep happening, and the overlays will become more recurring in nature, which means governance around these overlays will become more important than the governance around the base models themselves. Yeah, this is likely to become one of the highest supervisory scrutiny areas going forward, which we believe. The third aspect on the internal audit. Now, while the internal audit is already doing a lot of credit-related audits in the past, now the traditional credit audit capabilities alone will not be sufficient. Now, these teams will increasingly require the blend of skill sets, right? One is on the quantitative understanding, the accounting interpretation capability, the whole model governance expertise. Now, because ECL sits at the intersection of all these aspects within finance to risk to technology to business, and those kind of a blend of skill sets which would be required with the audit teams also. And the last but not the least, on the ECL breaks the organizational silos. If we look at it, how it would be implemented, while the risk would be owning the modeling aspects, finance would be owning the reporting parts, IT would be owning the architecture, while the business is influencing the portfolio behavior, and the economic team or the treasury influences the macro assumptions. Yeah, and the internal audit will validate each and everything, the whole governance part and the controls part of it. So ECL ultimately becomes an enterprise-wide governance program. Yeah, and hence the final RBI directions make one thing very clear, that RBI does not want ECL to become a black box statistical exercise, but the framework is deliberately designed to ensure that the judgment remains, but it is governed, it is explained, auditable, and the supervisory friendly. In that sense, governance is no longer a support layer around the ECL. Next slide, please. Yeah, this is our final slide of the presentation. A quick view from our side, that what is going to be the impact in terms of directionally, what do we see? Now, the impact of the ECL in India is unlikely to be uniform, as we have seen it other geographies also. It will heavily depend on the portfolio mix, bank to bank, the underwriting quality, the whole seasoning profile, and the exposure mix in terms of secured, unsecured, and the existing prudential buffers which the banks have under the incurred loss framework. Now, if we talk about from the bank's standpoint, right, the large private banks, which we believe may face more earnings volatility than the solvency pressure because of unsecured retail and the stage 2 corporate exposures, while the PSU banks and some mid-sized private banks could face higher transition pressure because of unsecured retail exposure, MFI and agri concentration, to prudential buffers which are quite thin, or the legacy asset quality issues. While the regional and the conservative banks, if you look at it, may actually benefit from the traditional conservatism, secured underwriting, and the lower SMA populations, if you look at it. And the foreign banks now, they are quite standing at a quite different juncture, if you look at it, because they are already globally aligned to the IFRS 9 in many cases, right? So their challenge may be less around the modeling and more around the localization to RBI specific prudential expectations. That's what we are expecting. So this is pretty much kind of what we wanted to cover today. This was the last slide. Happy to answer if there are any questions from the participants.
Yeah, you could raise your hand and then we can unmute your line in case of any questions. And maybe I'll just cover off one question then, which is on the chat box. It says how segmentation under RBI ECL guidelines would interplay with existing segmentation that the bank holds. A vehicle loan given to a farmer may be classified bank as agricultural loan given it fulfills their priority sector lending. But under the circular, the classification as vehicle loan might be more appropriate. So how should one approach under these circumstances? And I think it's a good question. Look, ideally, the expectation is the consistency of classification under all the reporting frameworks, unless it is a very specific regulatory diktat to present it in a particular manner. So in substance, how you classify a particular exposure for FIN reporting should not be different from how the ECL calculations are being made in the context of the classification. If there are other regulatory reasons for other classifications, that may still be okay. But just ensure the consistency between your financial reporting classifications and classifications for ECL calculations.
Sagar, we had a question from Surya Narayana. I have you can unmute yourself and ask the question if you still have the question. Okay, we have another question.
Then one of the other questions on the chat bot is RBI can't change Ind AS 109 requirements for NBFCs unless approved by the MCA. So is that a statement or is that a question?
Sagar, we have a question from Tapan Mishra.
Yeah, sure.
Yeah, hi. Actually, as per the direction, so bank required to fair value all its assets as on 31st March 2027, right? And my question, especially the portfolio in HTM book in investment side. So do we need to fair value all those assets, all those investments in HTM as well, including the G6? Probably most of the banks are having G6 in HTM. So am I audible?
Yes, you are. Ashish, you want to take that? Ashish, you're there? Yeah, no problem. Maybe I'll respond to that, Tapan. So look, the requirement for fair valuation is effectively for the loan portfolio, actually. So if you read or if you look at para number, and we can just message you or call that out. But yeah, the predominant requirement is for the fair valuation of the loan portfolio, not the investment book.
I'm sorry, sir.
Para 19. Yeah.
Sir, I'm sorry. With the ECL direction released on 27th April 2027, along with this direction, many other amendments were there. So
Yes.
if you go through those amendments, one amendment was classification on valuation direction.
Yes.
There it was mentioned that we have to fair value the HTM portfolio as well.
Yeah. So which is fair, but so sorry. So your question is in the context of the interplay with ECL?
Yes.
Yeah. So look, from a
Because the
ECL
direction, the amendment was because of the ECL direction only.
Yeah, no, absolutely. So effectively, first principles of saying that nature of investment. So fair valuation will be done opening transition adjustment. Central government securities, SLR qualifying state level securities will not have any ECL anyways. For other non-FVTPL positions, one will have to work out a ECL. And that's how... Yeah.
I'm sorry, but this fair valuation aspect is related to accounting aspect. Probably it is not the ECL side. So probably they want, I mean, the problem is if we're not taking those investments to ECL, so do we really need to fair value those things?
Sorry, Tapan, I lost you a little bit on that first question. Can you just repeat your first question so I get the context? That's the reason I requested Ashi, because I just missed half your wordings. So if you can just repeat your first question so I can appropriately respond to that.
The question is, so RBI, the direction says that we need to fair value all the assets as on 31st March 2027.
Sure.
Now question is, asset means we have investments as well, especially in HTM book. Those assets also needs to be fair valued.
Yeah.
Now question is, in HTM book we are having many. G6 are there. So do we really need to fair value those G6 in HTM portfolio? Because that fair valuation in HTM investment means we have to mark to market actually.
That is correct.
So that aspect is pinching us. I mean, that's where.
Yeah. So look, so I don't think there's an exemption to it. So one will have to comply with it. Now, the interplay, right, with this particular set of directions is going to be limited in the context that it's going to be a fair valuation that one will have to do and comply with. So yeah, so there's no exception of not being able to do that, Tapan.
Okay, sir. Thank you.
Sagar, we have one more question from Swatantra Gupta.
Sorry, Shyam, can you hear the participants clearly? I'm losing half the wordings on my connection. But yeah, please go ahead, Mr. Gupta.
Jimmy, can you unmute him?
I have unmuted him.
What is delay seems to. But his question is already there in the chat box. So Bharadwaj, do you want to answer that? Yeah, please go.
Yeah. So mainly from a solution implementation point of view, right? I mean, as rightly pointed out, we are probably 9 months away from the first implication. So it's since the Excel models would already be available, It's more about how quickly these Excel models can be kind of translated into a solution framework as a first step. While in parallel, there would be discussions on what would be the exact implications on the final accounting as well as the other statements part of it, right? So if you have to break down the overall implementation life cycle over the next 9-month period, the first 3 months period should be in making sure that the Excel models are automated into the solution framework, as well as making sure that the data part of it is rightly captured, because a lot of dependency would be there on the historical data sets. And then once the 3-month phase is done, it would be more about making sure that these models are run and then the implications are factored out as well. So thereby within 6 months time frame, you will have the realistic output, and then a 3-month time frame to make sure that any tweaks or any model refinements that have to be done, you'll still have the buffer to make sure these aspects are covered before the 1st April 2027 deadline hits.
So any other question? I
There
think
are certain
still have
questions in the
yeah.
chat. I'm just going through that.
Yeah, please.
Jimmy, the chat is only just comments. There's no question there. Yeah?
So there's a question from Mr. Bhaskar Krishnamurthy. How is validation of proprietary models, say a rating model or a bureau score card model?
Yeah. Suresh, you want to take that, please? Or Sham?
Yeah,
Sham, this is on.
Sure,
So how should how is the validation of a proprietary model how should it be undertaken? That's the question. Yeah, go ahead, Sham.
So I think there's not too much difference in terms of how the validation test has to be performed. But yeah, of course, when it comes to third-party models, the RBI put up more scrutiny about whether there's enough documentation around what the model design, what is the model concept is there, the assumptions and limitations on the model. So if you look at purely from the perspective of validation technique, be it your qualitative validation or the quantitative validation, those will remain same. But it's just about how the model documentation has been done and a little more scrutiny about third-party model. I hope that answers.
Next is, are erosion criteria technical write-off conditions as per IRAC norms applicable on 1/4/2027?
So can that question be clarified, please? Erosion criteria. Who is this question from, Jimmy?
Mr. Yagnesh Mistry.
Mr. Mistry, can you just clarify that question, please? You want to unmute his line as well, Jimmy?
Yeah. Just seeing whether he's still there on the call. Yeah, he's there. I've unmuted him.
Am I audible now?
Yes, you are.
Okay. So this is Yagnesh. My
Yeah,
question is, as per the existing guidelines on IRAC classifications, there's a set of parameters which says ki if the security is eroded by more than 50% or 10%, then the asset is to be treated as doubtful one or loss asset.
Yes.
So the ECL framework, which has come on 1st April, does not explicitly mentions this specific nuance.
Yes.
So is the understanding correct whether this will not be applicable?
Yeah, no, that's so it's a fair question. Now I understand it better. So here effectively the recoverability assessment of collateral has to be built into the loss given default or the LGD metric. Okay. And then let's assume that the collateral value is greater than 7.5 crores. Then once every 2 years, one has to get that collateral independently valued. And basis that recovery, one draws out the future cash flows and discounts it to the reporting date, compares it with the carrying value, and the delta is the ECL. So some of those time-based erosion percentages are no longer required to be followed, as long as one is appropriately following the LGD calculations in the manner which I just prescribed. Having said that, for the first 3 quarters though, till 31 December 27, when parallel reporting needs to happen, for that, of course, all the IRAC norms in their entirety still need to be continued to be followed till that date. Does that answer your question, Yagnesh?
So basically, you're saying till 31st December it will continue. After 31st December, all these erosion in value of security are to be covered under the model of ECL of LGD and PD.
Yeah. So till 31 December for IRAC reporting, it will
IRAC reporting, correct.
But for ECL reporting from 1 April 27 itself, the basis of measurement is very different, and this will not be relevant.
Noted. Thank you.
Yeah, thank you.
Sagar, there are no further questions on the chat and no further hands raised. Okay, no, wonderful. So thank you everybody for your time. Really appreciate your participation, and hopefully the webinar was a valuable investment of your time. We will send out some feedback email as well. Do respond to that. And yeah, wishing all of you the very best as you embark on your ECL implementation journeys. And we'll be in touch. Thank you so much. With that, we'll terminate the webinar. Thank you.